Hey guys, welcome back. And if you're new to my videos, my name is Max and I'm your Austin Realtor. Recently, I've had several buyers ask me questions about seller concessions, buying down the rate, so I thought it would be a great idea to invite in Austin Mortgage Lending, one of the most productive lenders in all of Texas, along with my broker to sit down and have a quick chat. So here we have Tony Elias, broker of Volt Realty, along with Stephen Roberts, the owner of Austin Mortgage Lending, and one of his loan officers, Kristen. I hope you enjoy. My name is Max. I'm a realtor with Volt Realty. This is my broker, Tony Elias, owner. This is Stephen Roberts, owner, Austin Mortgage Lending, and a loan officer as well as Kristen here to join us. And so we want to go over a few different circumstances and solutions that we can take advantage of. So the first one is I want to talk about where the current market is right now. The interest rates as of yesterday were around 7.3%. What are you seeing, Stephen?
Well, obviously, I think the feds are trying to get inflation under control right now, but what I'm seeing now is that more than ever, there's more inventory on the market and houses are becoming more affordable and sellers are willing to give concessions now, negotiate on repairs, actually put you in a great position to actually come to the table with less cash to close and perhaps even use a seller credit to buy that rate down and make that home more affordable. So from one standpoint, back when rates were 3-4%, we had very limited inventory, lots of competition, so a lot of people were exited the market. They either got discouraged and rented, or perhaps, if you had an FHA or a VA buyer, they would not get their offer accepted because a lot of the cash buyers and conventional buyers that were going 50 to 100,000 over, were the ones that were getting their offers accepted. So one of the encouraging things that I'm seeing is that even though we have less applications and less pre-approvals, the clients that are making offers and are shopping are getting their houses under contract, and they're actually getting it at a below market value. And so that's encouraging to see.
So, Tony, you obviously had a lot of experience with the market in the past, right? And how was it for a home buyer a year and a half ago?
Well, I'd say the biggest difference was that, they didn't get to pick the house they wanted. It was basically just they had a few options. And then if they really loved a home, then there was maybe 10, 15 offers on it. And it was a very slim chance of them getting that home. So they really had to compromise quite a bit. It seems, I don't think a lot of people have an idea unless they shop during that period of time, what they had to give up. I mean, right now we're focusing on the negatives, in the market, and that's what we see on the television and YouTube. It's the high interest rates. But now you get to pick your dream home, and it sounds like you would always have that choice, but you did not have that choice the last couple of years.
Yeah, interesting enough, I mean, during that time there was a lot of investors that were buying from California, Colorado. They were paying cash, and so these investors, and so the little silver lining is that with the rates going up, they're no longer able to cash flow on that investment. So a lot of the investors have exited the market, from that standpoint. Also used to have these institutional investors, like big companies that were buying tons of houses to put their employees here and then renting them out. So you had all this outside pressure, that was driving up prices. And so it's kind of nice to see that, like you mentioned, that less competition, being able to get that dream home that you need.
Yeah, exactly. And it's funny you mentioned that I remember there was, at the beginning of this year, there was so many houses under contract by these institutional buyers. And I thought, man, owning a home is going to be a thing of the past because and then I saw some builders were building out communities, and then they would just lease them out.
And they were going to be landlords instead of selling the house. Yeah, exactly.
I always say it's always an exciting market. Back in the day, which was just, backtrack 6 months ago, it was an exciting market because the emotional roller coaster was all of the bids you're putting on all of these different homes, hoping that you would get it. But now it's an exciting market because we can negotiate, right? So the back and forth is no longer on just submitting an offer and hoping it gets accepted. It's now the back and forth of negotiating seller concessions, negotiating who's paying the survey, like negotiating on the back end for us. And that's huge for us at Austin Mortgage Lending. Like that's when we come to the table and we're able to bring in the strong arm, I guess you can say, but do the math on seller concessions and how we can get buyers affordability in this market. So it's always exciting.
Yeah, no, I think that's a great point. So let's roll into that real quick. So a lot of times we're seeing, sellers being discouraged based on maybe the house is sitting on them, not getting enough eyes on it, or how do I get my house attention with all the builder competition and all the increased inventory. But what's some ways that we've been able to work with listing agents and buyers with submitting offer on, let's talk about the temporary buy down and what's called a permanent buy down.
Permanent buy down will affect affordability long term. So essentially you're asking for concessions to buy down the rate for the life of the loan, right? 30 years. And it just really just depends on, one, debt to income ratio to get our buyers in the home and qualify for it. But the other is, what is their long-term plan? Because if they don't plan on being in the home for their lifetime, then maybe not buy down the rate for the 30 years, but buy down the rate and do a temporary buy down. So temporary buy down is buying down the rate either, I'm sure you've heard, 3-2-1, 2-1, or even 1. The most popular one is 2-1. And some people have even labeled it as the date the rate program, right? Because essentially you're buying down the rate for the first 2 years. So for example, if rates are 7%, then the first year you're actually buying it down 2 points, so you're buying it down to 5%. So you're paying 5% for the first year, so then the second year it's the 1, you're buying it down to 6% the second year, and then by the third year you're actually back up to the 7%, but it'll stay that 7% for the rest of the loan, years 3 through 30.
So it's
right?
not adjustable at all.
So it's not adjustable. It's very different from an ARM loan. It's not going to balloon on you. And so I think some people, that's a big well, what happens if one day I wake up and it's 12%? That's not what we're signing you up for on the dotted line. But the goal is that if you are planning on refinancing, what we're anticipating, right, in this next market over the next year is the rate will come back down to the 5s. Is what's anticipated. So if that's what's on the agenda, then for us as lenders looking out for the buyer, okay, how can we help your affordability these next 2 years, and then help you long term after that? And if we buy down the rate in a temporary buy down, that actually has to come from the seller as seller concessions. And so that's when you guys come into play, right?
Yeah.
You guys know the market the best, right? And on the front end, you can check comps in the area. You can say, okay, this is what homes are going for. This is what we should ask. And that's when we come in and negotiate with you all, right? And then we run those numbers for you guys. So if we're doing the 2-1, the temporary buy down, we're actually able to buy down the rate for the 2 years, and that money gets held in escrow, right? So it's just like a little escrow account, and it's going to be submitted. Their interest rate is going to be their interest is going to be submitted with their principal payment, right, for those first 2 years.
Yeah.
Now, whatever is not used once they refinance, that actually gets rolled into that money that's saved in their escrow. Say they don't use it all and they refinance within the first year, then they get that money back essentially, and they can roll. It's almost like their refinance cost is.
Yeah, that's the beauty of the temporary buy down, is any seller credits that you get gets held, and then if you don't use that money and you happen to refinance before that first 2 years, then you get that money back and you can actually use it towards the cost of refinancing your home. And so it's nice. A permanent buy down, a lot of times you're going to see a lot of misinformation out there, like where builders especially are offering $10,000, $15,000, $20,000 to buy the rate down to make it more affordable, but you're kind of shooting yourself in the foot, because if you put $20,000 towards a rate permanently, and you have an opportunity to refinance within 12 months, that money's gone. Once you buy down, that's called prepaid interest. That money, in order to fix it in for the long term, that money is spent. The beauty of a temporary is it gets held in escrow. And so if you have that opportunity, you get that money back. And that's the biggest difference right now that people are not understanding.
Okay.
Even agents on both sides. It's really, because we've never had to talk about credits, right? We never had an opportunity to even get a credit. Yeah. So it's a good thing. It's a good discussion, but we just have to educate on which one's the best way to go.
Perfect. Okay, so let's do numbers for a second.
Yeah.
Let's say someone, a buyer is coming in and they love a house. It's priced at $500,000.
Right.
And now the seller is flexible, and the seller says, I'd be willing to go down to $490 or $480, right? Yeah. So the agent, knowing this, says, okay, well, let's talk about seller concessions, right? What would it cost for a 2-1 buy down?
That's a great point. To be very specific, it's the savings that you earn in your first year plus the savings you earn in your second year on your payment. And that total year 1, year 2 savings is the amount that you're going to ask the seller for. Okay. So that's a very simplistic way of saying, so it changes with the loan amount, by the way, because if you buy down 2 points on a $500,000 loan versus a $300,000 loan, it's going to cost a little bit more seller concessions. But on conventional loans, you can get up to 3% back on your primary home. On FHA, they'll give you up to 6% back. On a VA, they'll give you 4% seller credit. So we have a lot of room. For simplicity, like on a $300,000 loan, 3% is $9,000, and 6% is $18,000. So you have more room on the FHA to get those credits.
Okay.
But in terms of cost, you're probably looking at very round numbers here. You're probably looking at like $10,000 to buy the rate down, like a half a point to a 3/4 of a point, and then on a temporary, you're probably going to be looking at $6,000 to $7,000, but it's going to buy it down 2 full percentage points. So instead of going from 7 to 6.5 and costing 10 grand, you're looking at spending less than that and going from 7 down to 5%, and then 6% that second year. So much cheaper because you're only buying it down for 2 years versus the 30.
Okay, so what would you say to someone right now who, let's say they want to buy a home, or they're even thinking about buying a home, but they're too concerned about the interest rates? Obviously, there's a lot of volatility, right? So interest rates are going up high, and they're like, well, I'm concerned. What if the interest rates go up to 8% by the end of the year?
Yeah, that's a very good point.
What do we say?
Yeah, I mean, there's the best thing is to talk to a lender that knows what they're doing, because at that point we're able to look at their debt to income, right, and say, hey, what we can qualify you is really based off of the house that you find and the seller concessions that you're negotiating, right? So we qualify them, but then as they find a house out there and they say, hey, I found this house, they're actually willing to give $12,000 in concessions, and that's going to affect their affordability. And we always go back to, we always approve on monthly payment, right? Like what is the buyer, I mean, of course there's like a max that, say a person's like approved for $600,000, but really they only want to spend like $2,000 a month on their expenses because they have a travel lifestyle that they love to live, right? So that's when we go back to their monthly budget, right? And then we look at a home that they're looking to buy, right? And then we kind of work the numbers backwards based off of concessions that we can negotiate, right? So it's always great to, if somebody is looking at a home, don't think that their affordability is so shot out. And I think that that's kind of I think the worst part that a new buyer can be in is because they're just looking at Zillow and they're just looking at a purchase price, and they don't really realize that there's so many moving parts now versus the market that we were in 6 months ago. They would look at the purchase price and say, okay, well, I need $50,000 above purchase price to get into this home, right? And now they can look at it and say, wait, now I need to talk to an experienced realtor that knows how to negotiate, and then I need to talk to an experienced lender that also knows how to put the pieces together to help that affordability. So I would say it's never a no when they're looking at a home. If they're looking at it, always ask. Yeah.
Right. Yeah. I mean, I feel in the past there was a whole bunch of buyers out there that, let's say, didn't have 20% to put down on a home, right? And so they're going at 5%. Now, when you're putting an offer in and you have 5% down or 3% down, you're just not as competitive as someone who has 20% down.
Right.
So there's so much discouragement, and people weren't able to get into a home that now.
It's not even the case,
Yeah, and that first-time buyer was out of the picture.
Yeah.
So first-time buyer, you can put as little as 3% down, and so they weren't even considering those offers, like you're saying.
Right, and so can we do a 2-1 or a 3-2-1 with all these other programs, VA,
Absolutely.
FHA?
Yeah.
So it's not specific to conventional. You can do it with VA and FHA. As a matter of fact, you can actually buy it down more. Government rates, which are FHA and VA, actually are lower than conventional rates. So if you let's talk to the people that are concerned about financing.
Right.
So typically above 660, 670, you're going to be conventional. Anything below that, people are kind of discouraged. They don't know that if they can or they can't get into the home. But FHA allows you to have just a 580 credit score and put as little as 3.5% down. And the beauty of that, I'm doing a loan right now where a person it's about a $350,000 loan, and their cash on that to close that they have to come to the table with is about $12,700, because we got all of their seller credits, all their closing costs, their title policy, all the everything's paid for by the seller, and we're able to buy that rate down. And so if you're worried about how much do I have to come to the table with, now's the cheapest time that you'll ever have, because we're all talking about rates and payments, right, and affordability. Right. But there's a whole nother spectrum for that buyer that doesn't have $20,000, $30,000 put down. They've only got $12,000 to $14,000. And
Yeah.
you can do that now and have that seller pay for all your closing costs.
Yeah, I'm working with a VA buyer, and 6 months ago, again, would totally be out of the market. But he's VA. We're negotiating seller concessions. The property was $249,999. They submitted an offer for $247 with max seller concessions 4%. And so we're going to use half of that to buy down his rate, do a 2-1, and then the other half to go towards his closing costs. His closing costs will end up around 6 to 7.
So all the closing costs are paid for. You're
Yep.
buying the rate down,
Yep.
and this VA buyer
VA
is
buyer.
able to put zero down
Yeah,
and have all
zero
their
down.
closing costs paid for and buy the rate down.
Literally
And buying the house below market.
Right, literally
And so-
buying a $247,000
Instant equity.
home with $6,000.
Yeah, and what's going to happen in the spring
Yeah.
when rates come down to 5.5 on that home that you're buying now?
Right.
Right, it's going to.
And the values go up.
Correct. Yeah, so that's, you asked me what's going to happen when it's 8%. Well, the values are going to you're going to get them, the houses even cheaper. It's not
Right.
great for the sellers, to be honest with you. I mean, the ones that are actually selling have to sell.
Right.
And the ones that don't, they may wait till the spring. But if you're a buyer sitting on the sideline and a listing agent or seller, has to sell, then you take advantage of that. Because when the rates come back down to 5.5 and come spring, the the prices are going back up. And
Right.
I know everybody's trying to time it and buy at the bottom. It's really difficult to time it,
Yeah.
because once that thing turns back on, you're going to see a frenzy like you've never seen before.
Yeah.
Right.
You think the last frenzy was bad? It's about to get really bad.
That's right.
Yeah.
I mean, so wouldn't you agree? I mean,
I think that
Yeah.
you're right. I mean, I look at the cycles of
Yeah.
the Austin housing market, and we always see this. It's always a dip in this time of the year,
yeah,
and then it comes back up in February and March. March gets crazy, April peaks, and then May, after those closings, it tapers off. So I think that that's still in play, right? Obviously, we have bigger factors like interest rates and the economy and things like that. But if the interest rates go back down, I mean, inflation can only peak so much.
Yeah.
Obviously, we're fighting it with the Fed. So once it gets a little bit under control, if the timing synchronizes with that cycle, it's going to be crazy
Yeah.
in spring. And I think there's going to be a lot of regret of not purchasing
Yep.
during this time of
Absolutely.
year.
Yeah.
and remember, rent is 100% interest.
Right.
Okay, people don't realize that, but when you're paying someone else's mortgage, so yes, 7% seems high, but when you're paying someone else's mortgage, that's 100% is going to someone else's payment, which is interest. You're not getting any principal, any appreciation. So the nice way to think about it is it's 100% interest.
That's right.
Oh yeah, that's totally valid. And then also, I tell people, compare this to 6 months ago or a year ago.
Yeah.
Someone was buying a house and they're paying, let's say, $600 for it.
Yeah.
Well, now you get that house for $500.
Yeah.
You're going to be in a good position to gain equity.
That's
Right.
I mean that you're increasing your net worth by gaining equity. It's instant equity. How long would it take you? How long would it take the average buyer to save $50,000 to $100,000?
Right.
If you were to, a lot of Americans are having a hard time saving right now, and it's because of cost of goods. It's like, imagine being in a position where you can increase your net worth by $50,000 to $100,000 overnight. I mean, that's a fantastic position.
That's right.
So
Yeah. So right now we look at reasons why not to buy. Right. The biggest reason why not to buy right now is people are concerned about the high interest rates. But if we have a way to get around that, we can look at the reasons to buy. Obviously, the inventory we just haven't seen this much inventory in years. All right. There's all these programs that are now available to someone where you have a competitive offer. I mean, how many sellers do we see that are saying, bring me any offer to the table? Okay. Now we can put together an offer. The buyer is in an advantageous position to utilize every program out there. So the biggest thing we want to make sure is that buyers are well educated on every program available to them.
Yeah.
How much money can they save getting into a house right now? So also one thing I want to talk about is, let's say you have to sell a home. You have a few listings right now, and someone decides, I need to sell a home. Let's say they're moving. Right? And you say, well, it's maybe a better time to wait till the spring to sell a home, but they say, no, I absolutely want to do it. What can a seller do right now, especially maybe partnering with a loan company, to put themselves in the best position to sell their home?
Yeah, I mean, I think that's one question I had for you guys is, what's the best way to educate? What I find myself having trouble with is sometimes buyers and sellers, if they don't understand something really well, it's not talked about yet. Like this Buydown, the 2-1. I mean, that wasn't around. We didn't need it
Yeah.
2 years ago or
Yeah.
a year ago. So, because it's a foreign concept and it involves a lot of money and they aren't familiar with it, they're hesitant.
Yeah.
And so, what's the best way to educate them? Because I mean, I feel like it has to come from a lender, right? So, what would you guys recommend?
Yeah, go ahead.
We actually love partnering with listing agents and sellers, right? Because sellers don't know how their money, especially if the realtor comes to them and says, hey, like, let's offer seller concessions to move your property. Well, I don't even know what that means, like, why can't we just do a price cut? Well, we love to come in and talk to the seller too, to educate them. So we'll pull a 3-way Zoom, and we actually just did this on the road the other day. And we did a 3-way Zoom with the listing agent and the seller, and talked to him about how his dollar was gonna move differently for the affordability of the buyer, and he was so excited about it. He was like, awesome, let's do it. Like, what do we need to do to get this rolling, right? And we created we have the ability to build out the listing and market it a certain way so that we can show the affordability for the buyer. And he was so on board. And we also like to partner with them because now that we have the trust with the seller, we can help them on their next move when they're buying their next home as well. But did you have anything to add to that?
No, I just think, I think sometimes people are like, hey, they want you to give concession. You're like, why?
Why?
I mean, like, what's wrong with my house?
Yeah.
And it's like, it's a very emotional, sometimes sellers take offense to it. But when you say, well, if you do this, if you offer $10,000 towards your closing costs, you can effectively change the person making an offer on your home $500 a month in that first year, $300 a month in that second year, and you're going to now make your home more appealing to the everyday buyer. But to your point, how do you put that in words, right? So we're doing it on flyers, and the everyday person that's not used to doing numbers is having to look at a column. And for everyone out there, it's, if you take $10,000 off your purchase price, that's going to drop the buyer's payment by $50. But if you take that same $10,000 and you offer it as a credit to let the buyer use it towards his interest rate, now that payment's going to go down upwards of $500 a month. So it's like 10 times what it would if it was on the purchase price. And that's because it's being applied to the rate, like we talked about earlier, 7 to 5 and to 6.
Cool. Great. Are there any other common misconceptions or basic things that people don't understand that you're running into, especially buyers?
I think the biggest thing is when you truly, it's kind of, I'm trying to put it in layman's terms, but when you think, okay, how much more is my payment from 4% to 7%, right?
Yeah.
And then you think, well, it's going to cost me this much more a year. Okay, so that's an increase of 3 percentage points on every $100,000, which is about $3,000 a year per every 100.
Okay.
And so if on a $300,000 loan, that's costing you $9,000 more a year. Okay? But you were just okay with paying $50,000 over the purchase price. So how many $3,000, how many years does it take to recover that 50? Does that kind of make sense?
Yeah.
And so what we're trying to say is like, look, you're in a better position now. Even though you're spending $3,000 more for every $100,000 you finance, you're getting it cheaper. So you're actually in a better position now. And that's a big misconception.
Right.
And with the increase in inventory, less competition, we're able to negotiate repairs. I mean, I remember before, it's like take it or leave it. You would make an offer, you're like, hey man, your ceiling fan's falling down, or hey, your house is slanted. You're like, hey man, buy it or leave.
That's
you
right.
know, and people were wrapped aromeaund the block waiting for hours, and you had no leverage.
Nothing.
And it was almost to a point where everybody was just really arrogant. I mean, it was really hard to deal with both sides because they're like. And so that was the seller's market. It's now shifted to what we call the buyer's market, where the buyer has leverage again.
Right.
And that's a very nice, healthy, balanced market that I would love to stay this way.
Yeah.
You know, quite frankly, because it was not fun.
No. No.
You know, and so if you're out there and you're thinking about affordability, I've got a low credit score, you could not get your offer accepted.
Right.
They may still be thinking that way, but the reality is when you can go down to 580 credit score and come out of pocket $13,000 and have all your closing costs, now's a great time, because I'm telling you, when it turns back on, if you're that buyer, it's going to be very difficult to get your offer accepted.
Plus, to add on to your point, I think I love that, man.
Yeah.
That's a good way to put it with the monthly how much you save and the total. But the other thing is how many people actually had 50K. Not a lot. Not everybody had 50K to put over the appraisal value, right?
Yeah.
So now, not only are you getting really a better deal, if you think about it, because you can always refinance in 3 years.
Yeah.
But you have the ability to buy it because you don't have all this money saved up.
Yeah, and for those that don't understand, like when we're talking about going over, when the house appraised, because the market was going up so fast that there was not any data to support those prices.
Right.
And so the appraisals were coming in short. They were having you sign what's called an appraisal waiver. And then not only were you having to put the 3 or 5% down, but you had to come up with the extra $50,000 out of pocket. I mean, it's the first time buyer was having to put like $70,000 down if they got their offer accepted, which was like really. So yeah, so the misconception I think is now's not the time to buy it, but the reality is it would take you many years to recover the amount that they were going over. And now you're in a better position. Yes.
I think the question is, people are trying to time the market, and it's like the stock market. You can't time your investments, I mean, you try the best that you can, but we always say to the buyer, especially when I'm working with a first-time new home buyer, and they're like, well, I don't know, like, should I even do it? Like, the only thing that I can tell you is it the best time for you personally to buy?
Right.
Do you have some savings for down payment, cash to close, right? Are you in a financial position outside of that too, right? Like, are you stable with your job? Like, what does all of that look like? Are you going to be moving anytime soon? And then, it's the time to buy for you right now. So they can ask themselves that question. And that's the only thing that you can, as a buyer, ask yourself. Not like, well, is the interest rate, because everything else is going to change. The home prices are going to change. The interest rates will change. That's something that you can't control, but you can control your own situation and that decision that you make for yourself.
I truly believe that with these seller concessions and these buy down opportunities, you can get into a home and afford it and be able to put yourself in a great position down the road.
Yeah. I mean, honestly, I feel like everybody that's saying it's not a good time to buy is just very much thinking in a single little box. Whereas right now, there's so many different solutions out there to help you get around that high interest rate. I mean, if the interest rates were at 4% or 4.5% or 5% right now, with the way the housing prices are, everybody would be trying to buy a house. So it's that one factor that's holding so many people back, but there's solutions to get around it. And so now, take advantage of it. And to your point, if you're in a position where you want to buy or that you want to sell your home, make as much of this information available as possible so that people they can take advantage of any program.
That's going to be our challenge going forward, is putting it in a very simplistic form for all parties to understand.
We appreciate you having this, because this is what it takes, just to educate the masses and put content out there so that people can understand that there are solutions, like you were saying. So I appreciate you guys.
Yeah, thanks, Max. I think it's going to be extremely helpful for everyone here.
Kristen, Stephen, Tony, thanks again for your time. I really appreciate it. And then, as always, I'll have everyone's contact information in the details below. And feel free to reach out to any of us if you have any additional questions.